And I'm here tonight with Angela Colatriano, his head of marketing at College Ave Student Loans. We've been doing this for a few years. College Ave sponsors a lot of these types of webinars. They're a great partner because they truly want to help educate families on this process. They want to make sure that you understand the loan process and that you get the chance to ask questions and that you're honestly, at the end of the day, you're making an informed decision. It's truly, the goal of tonight. Sorry. And let me tell you one other thing is that we run these as meetings. And so if you can keep yourself muted, that would be great. For anybody who's willing to turn their video on, we don't want to peek, but we love to have faces. So we appreciate the people who have their video on, just so that we see a little bit of who's out there. And let me make sure the chat is, working. Feel free to put questions in the chat. We've got some slides that we're going to talk through, but I will interrupt Angela, or we'll kind of address some of the questions as we go along, and then we'll probably address a lot of them at the end. Hopefully you can bear with me. I just started 2 hours ago to have this hoarse throat, so I hope that you can hear me well enough. And Angela, if you could just tell us a little bit about yourself and College Ave, that would be great.
Sure. So as Debbie mentioned, I am the Chief Marketing Officer at College Ave Student Loans. We are one of the top private student lenders in the country and are really dedicated to try to take as much of the stress out of paying for college as possible. The way we do that is trying to be as simple, clear, and personalized as we can be. And we love the forum that Debbie provides here because these are confusing topics. And we love being able to educate people so that you can really make the right choices about how to pay. And if borrowing is for you, you can shop in an educated fashion.
Great. Okay. So we are going to, let me share the slides and then we will get started. Oops, no, sorry. Hold on. Got it. Okay. Are you seeing the slides? Or are you seeing something else?
It says you started screen sharing, but I'm not seeing the slides yet myself.
Okay, hold on. Let's see what's going on. I'm not doing it right. Nope. Can you see it now?
Yes, now I can see it.
Okay, great. Okay. So let me just pull up, sorry, one last thing, the chat so I can see questions. Great. Okay, so let's get started. So somebody saying, will we be discussing Parent Plus loans tonight? Yes.
In detail.
Yes, in detail, exactly. Okay, so we've introduced ourselves. So to your question, so tonight we are going to talk about federal loans. We're going to talk about a little bit why it's important to start with the FAFSA, the different types of federal loans, which a lot of parents you probably already are starting to become familiar with because you've seen them on your financial aid forms, the subsidized, the unsubsidized. We're going to talk about the Parent Plus loan, and then we're going to talk about private loans and how you make this decision between federal versus private. Okay, Angela, I'm going to start with you. Why is the FAFSA so important?
Yes, so the FAFSA is really your gateway to any type of aid. So the FAFSA is the way you raise your hand and you tell both the federal government and the school that you want to be considered for any type of aid. And most of you who are here, many of you who are here have probably already completed your FAFSA for this year. If you haven't, definitely get that submitted. And then remember that you need to do it every single year. So every year your child is in school, you're going to fill out the FAFSA again. And again, that will give you access at the colleges to aid. That includes merit aid, by the way. That's the part of the way you raise your hand for merit aid. And it will also be your entryway to the federal student loans. as well as some federal grants that are available. So FAFSA, every single year, always make sure you complete it. There's really no reason not to. You don't want to miss out on any of the opportunities that it could open the door for.
Do you have any, just a little bit of like heads up for people about the
What's
FAFSA
coming?
changes? Yeah.
Yes. So particularly for those of you who have been through the FAFSA before, you are going to have some changes coming this fall. So typically the FAFSA opens for the upcoming season in October. So for any of you who have a student who might be going to college in August or September, you probably could have started, well, you could have started filling out your FAFSA in October of 2022. In this upcoming season, they are going to be making some changes to simplify the FAFSA process. They're probably a little bit behind where they would like to be. And so the FAFSA is not going to be opening in October this year. It will actually open in December. And you do want to try to fill out the FAFSA as close to when it becomes available as possible, because some aid that I referenced there is first come, first served. So you do want to fill the FAFSA out as promptly as you can. In addition, as I mentioned, so they are simplifying the FAFSA. They are also making a few other changes to the way that the formula calculates how much aid you may qualify for. And one of the big changes to be aware of is that it's no longer going to take into account if you have multiple children in the household in college at the same time. So that's no longer going to be a factor. So again, particularly for those of you who have already completed the FAFSA one time, maybe have some idea of how it went or where you fell from a student aid index point of view, that's going to be changing in this upcoming fall season.
And what about, Angela, like for families who maybe didn't fill out FAFSA in the fall because they thought, I'm not going to be eligible for any need-based aid, so I don't need to fill it out. Should they, still consider, and can they still fill it out now if they realize that they might want their student to take out federal loans and they might want to explore the Parent Plus loan?
You can still fill it out and you should still fill it out. So that would always be my advice. There may be some aid at this point that is not available, but it does not mean that you would have, all federal loans off the table or things along that line. So my advice is always, if you haven't done it, get it in as soon as possible.
And so just to emphasize, I mean, we're kind of discussing both the federal loans and then the private loans and how you make that decision, but you will not have access to any of the federal loans, and the two major federal loans are for your student, which are the federal direct loans, and for parents, the Parent Plus loans. You won't have access unless you fill out the FAFSA. And you don't have to have been awarded need-based aid.
That's right.
Anybody and everybody can fill out the FAFSA, regardless of what your income is. You have access to, your student has access to federal loans, and we'll talk about that
Yes.
in detail. And in theory, you have access to the Parent Plus loan, again, regardless of what your income level is.
That's right. Honestly, the simple rule is just fill it out every year, fill it out as close to when it opens as possible, because there are a number of doors that it can open.
Okay, so the first type of federal loans that we're going to focus on is for your student. They, I don't know if this is an old term, but the direct federal loans. Your student will either be offered subsidized or unsubsidized. And Angela, if you could kind of explain what the differences are.
Sure. So again, just to underline here, these are the federal loans that your student can take out in their name alone. So these are student federal loans. They are only in the student's name. There are two flavors of them. There is the subsidized version and the unsubsidized. I'm going to start with the subsidized, but that is the less common one. The subsidized does have a need aspect to it. So they are going to factor in your family's income as well as your aid that is needed at that particular school. So it is a combination of factors for your household and how much aid you need at that particular institution, whether or not you'll qualify for a direct subsidized loan and how much. What makes it subsidized is that the interest doesn't get charged while the student is attending school at least half time. So if they leave school, if they drop below half-time enrollment, that's when the interest begins accruing on a direct subsidized loan. So it does have an interest rate. They just don't accrue any interest as long as they're enrolled at least half time. And the school is going to tell you. So again, the way you get here is that you complete the FAFSA. The way you find out if you can get a direct subsidized or unsubsidized loan is by completing the FAFSA. And then the individual school is going to communicate to you if you qualify for the subsidized loans and the amount for the school. There are limits on all of these. We're going to get to those a little bit later on those limits. So for right now, I would just focus on the concepts of what's different between a subsidized and an unsubsidized, and then we'll talk about the limits that you might hit on either one of these.
Somebody was asking, could a student qualify for both subsidized and unsubsidized?
Yes, that's possible. So
yeah, go ahead.
Yeah, no, okay. So on the unsubsidized side, the unsubsidized loans are the ones that they're really not need-based in the sense that your family's income does not factor into whether or not you will qualify for an unsubsidized loan. Essentially, if your student is enrolled at least half time at, name the university, they're going to qualify for an unsubsidized loan. The most common reason that students would fill out the FAFSA and not qualify for that is that they're not enrolled at least half time. But virtually everyone qualifies because that is not based on your household income. So the unsubsidized loans, that is where the interest starts accruing immediately. So as soon as the money gets sent to a school, interest is accruing on that loan, and it will continue to accrue while they're in school and then be added to the balance when they graduate. I will note here that again, we'll talk more about these limits. But if you have a dependent student where the parent is not eligible for a plus loan, and we'll talk about why that might be, the limits will change on how much they can take in unsubsidized loans. So we'll talk a little bit more as we get into the next piece on what those limits are. But these are essentially the two versions of the federal loans that will be in the student's name only. And it really just comes down to whether or not there is a need from an income perspective and a school perspective, whether or not they will be charged interest while they were in school. That's the difference. And then the limits are also different, which we will talk about.
And I know you just said it, but just to emphasize it, maybe you can say it again, because we get this question a lot. A family will say, at one school, my student got offered subsidized loans, and at another school, they didn't get offered subsidized loans.
Yes.
Maybe just emphasize that again.
Yes, it is the combination of your family's financial situation as well as how much need you have demonstrated at that school. So in other words, if the cost of attendance is higher at that school and you have a greater need at that school, you may be more likely to qualify for a subsidized loan at that school versus the unsubsidized or versus a different school.
So that's not uncommon. So for the families here who have, graduating seniors or even students that are in college, you've probably seen that. And for the junior families, just be aware that you might see that at one school, you might qualify for both need and you might qualify for a subsidized loan, and another school you might not.
Right. That's right.
And somebody is mentioning, which is kind of interesting and not so great, they're saying, my daughter's college did not include the direct student loan in her financial aid package. We had to specifically ask for it to be added, which is unfortunate because, as Angela mentioned, every student, if you fill out the FAFSA, is eligible for the direct unsubsidized loans, and hopefully colleges should make that more clear. You shouldn't have to ask for it.
I would say that's uncommon. Most colleges do include that in the financial packages that come back when you're eligible for that. But certainly, I think that is a great example that if for some reason you've completed the FAFSA, you have unmet need at a school, and you don't see your ability to access that unsubsidized loan, it's certainly worth reaching out to the financial aid office to confirm.
Okay, so when you mentioned the limits, so maybe you can go through what these are and why it's so important to kind of know what these limits are per year and potentially take advantage of them.
Yes, so the limits are very important to understand, and there's a few components here. I'm going to focus primarily, at least to get started here, on the dependent undergraduate. I do think it's important to note that it is relatively rare for students to be able to qualify as independent undergraduates There are situations that can happen. Investigate it at studentaid.gov if you think that there's any chance that could apply to your family. But the reality is that most students from the federal student loan perspective are considered dependents and are going to fall under that left column of the dependent undergraduates. So the amount that they can borrow each year in these direct loans changes depending on how far along they are in school. So if you take a freshman, they can take $5,500. Most of them can take $5,500 in direct loans. Only a subset of that can be subsidized. So only $3,500 of that $5,500 could possibly be subsidized if you meet that need criteria we talked about.
So a student will never get the full 5,500 in subsidized. If they're eligible for subsidized, they will always have a combination of subsidized and unsubsidized.
That's why that is very common, because the subsidized limit is a subset of that overall $5,500 limit. You can only ever be qualified for up to $3,500 of that. And then you can see that each year in school, as they advance, they are eligible to borrow a little bit more sophomore year. They can get up to $6,500. Again, only a subset of that can be subsidized. They can get up to $7,500 once they reach junior year, and then then it stays at $7,500 each year. So two things to be aware of here. One is, let me answer the question now because we tend to get it, is why is the lifetime max more than that? Why do all four numbers not add up to the lifetime max? Because you may not graduate in 4 years. So if you are a fifth-year senior, in theory, you are still eligible for that $7,500 as long as you haven't capped out at the $31,000. So the $7,500 is the max per any individual year once you reach that level. And then you can borrow up to $31,000. The next important piece to be aware of is that you can't go back and reaccess these. So if you get to, let's say that freshman year, you say, I don't need to take that $5,500. And you get to sophomore year and you realize this year we could actually really use $10,000 and $6,500 isn't going to be enough. We didn't take the $5,500 freshman year. Can we take the $10,000 now? The answer is no. You can't go back and reaccess those prior dollars. You can't add them in. In any given year, you're subject to these individual annual limits. So the most you're ever going to get in a single year is, for most people, again, I'm ignoring that independent scenario because it's just less common. The most that most people will ever get in the student's name is $7,500 in an individual year.
But that's why it's so important to plan out all 4 years. I would, get a spreadsheet, estimate. Or pretty soon you'll know what your exact costs are going to be for freshman year, and estimate some sort of an increase in the tuition and room and board every year, and plan out, because you don't want to be in the situation of sophomore year, junior year, and realizing that you need to borrow more and you could have actually borrowed it freshman year, but you didn't, because as Angela said, you can't go back and get the money that you didn't borrow in previous years.
That's right. And I think I did see a question that said, if you don't take it for the first semester freshman year, but you need it for the second semester, can you access it? Yes, you can do that. If you're still within that freshman year, you can. The one thing I would note there is that one of the restrictions on using these direct loans is that you do have to be enrolled half-time. So what we do sometimes see is that people want to use it for summer, but they don't actually meet that half-time criteria. So they can't use it for that. So as long as you're trying to use it for, again, let's just use that freshman example. You're trying to use it for a semester where you are enrolled at least half-time, then you can access those funds, that $5,500 your freshman year.
And what about the idea of maybe you're not sure, but your student takes out the $5,500, and if you truly don't need it, you could pay it off by the end of the year.
You could. There is no prepayment penalty. You might need to do a little bit of research to figure out who your servicer is, because payments are not technically due yet on these loans. By nature, they're not due until the student leaves school. So you might need to do just a little bit of research to figure out where to send that money, but there is no prepayment penalty. So you could do that. You could take that loan and then you could determine that you don't need it and you could send it back in, pay it all off.
And what about the rates? There was already a question about how these rates are determined.
Yes. So the rates get set every year. They actually get set based on a treasury bill sale in May that happened relatively recently, and the rates this upcoming academic year have been set at 5.5%, and there is an origination fee of just over 1%. The origination fee actually gets added onto the loan, or it is a component of the loan. So it is important to note that, let's say you wanted to access that full 5,500, you won't get the full 5,500. You will get 1% of that is actually going to be for the fee, and you won't get access to those funds. It will just be a portion of what you borrow. And then the remainder would be sent to your school to pay for expenses. There is an origination fee. So all of these things repeat every single year. So for every year in school, you would repeat this process, and that is going to apply for federal loans or private loans. Essentially, you need to do it every semester, every academic year. You have a little bit of choice around semester versus academic year, but you're absolutely returning every year in school at least one time to complete the process. And you will have multiple loans, and on the federal side, you will pay an origination fee on each of those loans.
If a student ends up taking out a direct federal loan every year of college, they're going to graduate with 4 loans, and each loan is going to be at a different interest rate, because the new interest rate is set. It was just set. It's usually set in June, and every year we don't know what next year's interest rate is going to be.
That's right. We don't find out until roughly late May. You will see it in the news. And then it looks like the federal government recently updated their website, but roughly every May you find out what the interest rate is going to be for that upcoming year.
Now, there's a question here, and I know this also comes up a lot, of what if parents aren't supporting students after they're 18? Do the parents still have to file FAFSA? And I guess maybe if we can address this idea of what we as parents feel like our responsibility is versus what the government feels our responsibility is.
So that is why I talk about it as it is fairly difficult to have a student, a traditional student, designated as an independent individual, even
and just some criteria, like
supporting them.
To tell you some criteria is that, honestly, to be considered independent, first of all, I think you have to be 24 and older. You have to potentially, these are ors, you have to be married. You have to, I guess, like, have some declaration by the court system that you don't have, a guardian or so it's very, very difficult.
Yes, that's what I would leave you with. It is incredibly challenging. Again, if you think that applies to you, studentaid.gov is your best destination for all questions federal loans. There is a lot of information on there, but honestly, they've done a very good job with getting all of that detail in. So certainly investigate that. But I think it's important for most people to look at that and say, that is very unlikely that a traditional undergraduate student will be designated in that category.
Okay, so now we're at the PLUS loan. We're still talking about federal loans, but can you talk a little bit more about what the Parent PLUS loan is?
Sure. So one thing to keep in mind as we start to talk about the Parent PLUS loan is this starts to come into play again, because we talked about those borrowing limits of what the student can take in their own name. And those loans, those direct loans we just discussed that the student can take in their own name, are always the first ones you want to max out. So if you need to borrow, if you're comfortable borrowing, those are the ones that you want to take first. However, we just discussed that those come with limits. So that's where the Parent PLUS loan then begins to become an option if you're comfortable borrowing beyond those limits in the student's name. So the Parent PLUS loan is designed specifically, it is a federal loan. It is designed for parents. It is only in the parent's name, and I do mean the parent. So it is very restrictive in terms of what that definition of parent is. So you will want to, again, research that if you have a different scenario, but it really is designated specifically for parents. Parents take it in their own name. So the student's name is not on these loans. Students are not legally responsible for these loans. Only the parents are responsible for these loans. And there are some of those same restrictions where the undergraduate student does need to be enrolled at least half time, but as long as they're enrolled at least half time, it could be used for that. Couple things I'll note here that I think are not directly on this page, but probably important to understand. The plus loan can cover up to the full cost of attendance. So those caps we talked about on the prior page don't apply to the plus loan. So those can go all the way up to the cost of attendance that the school has calculated for the student. The other important piece of this is that there is a basic credit check on the plus loan, not a detailed credit check, but there will be some credit check that the government performs before they will approve a parent for the plus loan. It is fairly limited. It is, they are going to look to see if you defaulted on a prior federal student loan. They're going to look for some basic things along that line. And I do think it's important to remind people that they're not really verifying ability to pay. They're doing the most cursory of credit checks. So you have to be really comfortable that you want to and can take on this debt, because the credit verification that occurs at the point where you apply for a plus loan is not verifying that for you. You really have to take that responsibility on yourself to make sure you're comfortable taking this on. What did I miss, Debbie?
Well, no, I just think if you can talk about that, it is the same rate for everybody, what the rate is, the origination fee, that type of stuff.
Yes, so the rate for the upcoming year, the plus loans will have higher interest rates than the direct loans in any given year. The plus rate for the upcoming year is going to be set at just over 8%. And the plus loan also has a higher origination fee. So it's a little over 4%, the origination fee. It does work the same way that the origination fee is actually rolled into the loan. So you will also pay interest on the fee because it's just a piece of what you are borrowing. So really, I would say that you generally, we talk about it as it adds about 100 basis points to the interest rate. So a good comparison, a good way to think about it with the fee included is that it's probably sort of just over a 9% interest rate is a back of the envelope way to think about that and think about the overall cost of that fee.
So that 9% that Angela's quoting, when we talk about private loans, if you're trying to compare private to a parent plus loan, you want to consider the 9% is your apples to apples comparison,
right,
not the 8% that, or 8.05% that's listed here.
That's exactly right.
And the other thing to remember, and this is kind of like, a repeat of everything we're saying, is that if you're taking out a Parent Plus loan, every year it's a new Parent Plus loan. So unfortunately, what that means is every year you're paying an origination fee.
Yes.
You don't just pay it once, you pay it every time you take out the Parent Plus loan.
Yes. And I think we're getting a few questions here, which is probably important to answer. It'll be relevant in the other later parts too, as we talk about private loans. What is cost of attendance and what does it mean if you can borrow up to the cost of attendance? So the school is going to determine the student's cost of attendance, and it is tuition and fees, which I think, everybody, that's probably the obvious piece. But it would also include things like living expenses. So room and board if they're on campus, or an allowance for off-campus living if they're not living on campus. It includes an allowance essentially for supplies like books, necessary electronics, which, laptop is essentially necessary electronics at this point, as well as transportation. So there's allowances that all add up to that total cost of attendance. And that is where the borrowing cap is set for Parent Plus. So it would be set by the school, essentially. They would say this is the maximum you can borrow based on what we've determined to be the cost of attendance for your student for this academic year.
And I'm just looking through some of the questions, maybe before we go on to private loans, there's a few questions that we could address,
Sure,
that relate to the Parent Plus loan and the direct. Just to reiterate, one person is asking, will the college let them know if they qualify for both the subsidized and the unsubsidized, or do you have to ask?
They will typically make that apparent to you in your award letter. Award letters can sometimes be a little challenging to decode. We actually have some tools on our website, some blog articles and some things along that line that can help you with how to read them. I know we had somebody earlier who chimed in and that the school actually didn't mention the loans to them, but most of the time, yes, the school will make it apparent to you in the award letter if you qualify for subsidized and or unsubsidized loans.
And maybe talk a little bit about also some schools, how they list the Parent Plus loan on financial aid awards?
So plus is a little less defined, quite frankly. So as I mentioned on the direct side, the unsubsidized and the subsidized direct loans, those will almost always be on your award letter. Plus is not as cut and dry. You may or may not see plus mentioned on the award letter. Some schools package it, is what we call it. Some schools will list it on there as an option. Some schools will not. So you may have to reach out if you're interested in the Parent Plus loan. You may need to reach out regarding that. And actually, the way you apply for the Plus loan is that the first step is that the student has to submit the FAFSA. And then there is an additional form for you to fill out on studentaid.gov. So you can do that even without the school. But just understand that the school may or may not show the Plus loan on your award letter. It's really up to the individual institution whether or not they list that. And it's much less consistent whether or not the school will list a Plus loan.
And that's a good and a bad thing, because some schools list the Parent Plus loan and they don't make it clear. And it looks like, oh, I don't owe anything because the Parent Plus loan is taking care of everything.
Yes.
But they're not, the school isn't making it clear that that's a loan that they are making the assumption that you're going to take.
That's right. That's exactly right. And I think there was also a question about when the interest begins to accrue on the Plus loan. The interest does begin to accrue as soon as the money gets sent to the school.
And maybe just to emphasize again, somebody's asking, where do you apply for both the direct loans and the Parent Plus loan?
Studentaid.gov.
And I'm just going through these questions again before we move on. Just to confirm, somebody's asking, the 5,500 for freshman year includes both subsidized and unsubsidized. So that's correct.
That's correct.
And if the offered amount is low, can you ask to have the loans increased? I'm assuming if you're asking if the offer amount for the, honestly, the subsidized loans, they should always show you the 5,500 and it broken out between subsidized and unsubsidized. And again, just know so that you're an informed and educated parent that your student is eligible to borrow up to 5,500, whether the school lists it or not. And you should go back to the school and just make sure that they know that you that's what you're going to borrow. But
yes.
Everybody is eligible for 5,500. It's just the breakout between what's subsidized
yes.
and unsubsidized.
The only reasons why a school, and I say this, you should have the conversation with the financial aid office, but to educate yourself, if you need to have that conversation, if they're enrolled less than half time, that may be that's one of the only, I'll call it, common reasons why someone would not be eligible for an unsubsidized loan. So you might want to double check that piece of it. The other piece would be if the school has awarded so much aid themselves that they feel that your cost of attendance is covered. So they don't feel that you have any aid to cover. That's another situation why you may not see the loan listed. Again, in any of these scenarios, it warrants a conversation with the financial aid office, but that information may help you if you need to do that.
And here's another good question, and then we'll move on. A woman is saying that her son was offered the 7,500 and he's a sophomore, but in terms of credits, he's a junior.
It goes by credits. It really doesn't matter whether it is their first year. It is all based on credits. And if you do have sufficient credits to be considered a junior, then absolutely that 7,500 is what would kick in. That's a great distinction.
Yeah. And then they're asking, will he only get one more year of loans since he's getting the junior amount? I mean, technically he will get up to the 31,000.
Right.
So if in his second year, he's really considered a junior because of the his credit, in his third year, if he's considered, he will continue to get whatever the appropriate amount is for his credits up to the 31,000.
Yes. I think there was a question too about refinancing Parent Plus loans and eventually handing these loans off to the student. I do want to clarify here, we can sometimes be refinanced. So some private lenders might let you transfer a Parent Plus loan, they would be a now graduate, but to the former student whose education was financed with it. That is not always available. That is not consistently available. And it's not available from even every lender that offers refinancing. So I would just caution you that it's certainly something that you can look for. It may or may not be available. and there is no federal option. So there are federal loan consolidation options. There is no federal option that would allow you to do that. So it's certainly something that you can look into. It may or may not be available. So I would just caution people on assuming that that will absolutely be something that they can do.
Okay, so let's move on. So we just kind of, I think, went in pretty good detail on the federal loans. Now let's talk about the different types of private loans that are available.
Yes. So let's start with the private student loans. So these are in the name of the student, but they are almost always with a cosigner as well. Because again, if you just think about the vast majority of traditional undergraduate students, you're talking about 18-year-olds, they don't have the credit history or the income for private lenders to be able to approve them on their own. We can't look at them and say that they have enough information to warrant lending them money on their own. So there is typically a cosigner with them. The cosigner is often a parent, but it does not have to be a parent. You see aunts, uncles, any other creditworthy adult essentially can cosign the private student loan with them. They do typically allow you to borrow up to the full cost of attendance. So in that way, they are very much like PLUS in that they can fill that gap once the student has exhausted all of the federal loans in their own name. The interest rates are going to be based on credit. So better credit is going to equal a lower interest rate. I'm actually going to circle back to cosigner release just because it's a little bit more of an in-depth topic. So I'll finish the bullets and then we'll go back there. Unlike the federal loans, most private student loans don't have origination fees. That's very uncommon in this space. It is something that a private lender could do. Never hurts to double check, but it is not common. And you do always want to have a conversation here. So because most of these are co-signed, so most of these have two people who are legally responsible for them. They are going to show up on both people's credit bureau. Positive history is going to impact that credit score in a positive way. Negative payment history or not paying that loan back is going to impact both people who are on there in a negative way. So it's very important that both parties that are on the loan understand what they're signing on for, how they can impact each other, and that they, especially for a student where this is their first, often major financial decision, that they really understand how all of this works. I'll pause there and then I can go back to cosigner release. Okay. Unless you have a question before I go back.
No, I think you can go back.
Okay, so cosigner release. This is actually incredibly unique to student loans. If anybody's ever had a mortgage where you have two individuals on a loan, it is not easy to ever remove an individual and often impossible to ever remove an individual from a loan when you have multiple people, that loan was approved on the basis of multiple people. Private student loans are a little bit different in that sense because we do recognize that the parent or the cosigner essentially, was on the loan to enable the student to get the education, and then the student, in theory, can take over that debt once they've graduated and they can fully take that on. So we do recognize that this is a different animal in that sense of why people cosign these versus, again, say a mortgage where people are sharing and equally benefiting from that home. That said, each private lender does not have to offer this. They don't all offer it. So the first thing is, if it's going to be important to you to try to get removed from this loan before it is completely repaid, look first at, do they even offer it? And then the second component is to verify what their criteria is. How transparent is their criteria? How clear is it? What will need to happen? What you will need to do, what the student will need to do in order to qualify for release? Because you will find, first of all, again, some don't do it. And some, it is essentially you can apply, you can ask to be removed, they will review it, but they won't tell you what criteria they're looking for or what hurdles you need to make sure you jump to be approved. So look for, do they offer it, and look for transparency of policy around what steps need to be taken in order to be approved for the release.
And maybe just to give people an example, what's the cosigner release policy for College Ave student loans?
So we require, it has to be halfway through the repayment term. And then we require, so all of the detail is listed on our website. I would encourage people to go and look up the exact details, but we essentially are going to be looking for a positive repayment history for a period of time. And we're going to be looking for the student to be able to evidence income, or the former student to be able to evidence income that is, I believe it is twice the outstanding amount of their loans with College Ave. So, but it is very clear, it is very transparent. You can see exactly when you could be removed and exactly what will need to occur for you to be approved when you reach that point.
So again, that's something as a parent, you should understand as you're looking at different lenders, to have a sense of, if it's important to you, which I assume most parents it's going to be, at what point can you estimate that this loan can be fully in your student's name?
That's right.
Okay, so a lot of people might not be aware of what a private parent loan is and how it compares to a private student loan.
Yes, so private parent loans. Parent is probably a little bit of a misnomer here, but it is named that way to help people compare it to the PLUS loan because it is somewhat similar to the PLUS loan, but it doesn't have to be in the name of a parent. It's really almost more of a sponsor loan. So a private parent loan, and check this for any private lenders that you're shopping because they could put different restrictions on, but I am speaking in general that it is not restricted to the parent in the same way that the PLUS loans are. That said, it is that credit-worthy adult, let's call them, who wants to take full responsibility for the loan. The student is not responsible for the debt. So this will not be on the student's credit bureau. The credit-worthy adult, again, often a parent, but doesn't have to be, is the one who's taking on full responsibility. Again, this will allow you in general to borrow up to that full cost of attendance. And a big difference here is that they don't have private parent loans don't have origination fees. And they also will base your interest rate on your credit. So if you are somebody who has positive credit, you may be able to qualify for a lower interest rate in the private space than you would on the Parent Plus loan, because the Parent Plus loan is going to be one rate for everybody, regardless of credit history. So it's certainly something it's worth shopping. If you are considering Plus, all of these options are worth shopping so you can compare your options and weigh, do you want the student on the loan or not? Are you comfortable being the sole person responsible for it? And where, can you qualify for a better rate in the private space? And again, I'll just always make sure to factor that origination fee in because you probably won't be paying an origination fee on the private side.
So this question came up in our Facebook group, actually just the other day. Somebody shared that they started the research and they've been looking at rates and they got, and I don't know the specific rate, but they got one rate for a private student loan and they got a higher rate for a private parent loan. And they were just surprised that the rates were that different. So
Yes.
Why would that be?
It essentially comes back to the risk that the lender is taking. So if you think about a private student loan that has two people on it, so you have the student and the parent, that's actually reducing the risk of that loan. So you can offer a lower interest rate on that loan because you have two people who are taking responsibility for it versus a private parent loan that's only in the name of one individual. Now, here's what I would say though. I would not say that that is a hard and fast rule and that you're always going to see a lower rate. That's a specific situation that if you do apply and you get two different rates on them and the parent loan is higher, that is most likely the reason why, because there's only one person taking responsibility versus two. But don't assume that one or the other would always have the lower rate.
So what type of decisions do you think it comes down to, like that families and parents need to decide as they're thinking through, should I consider a Parent Plus loan or should I consider a private loan?
Yes.
I mean, you've kind of touched on it, but I think it's worth really emphasizing.
Sure. Yeah, I mean, really, we always tell people once you get past that point of if you still have a gap to fill once you've exhausted those direct loans in the student's name, and if you and the student or the student are still open to borrowing, my recommendation would be to shop all three. And then what you need to weigh is how you feel about who's taking legal responsibility for the debt. That is often one of the big gating factors we see that will send somebody from, I'm not comfortable taking Plus because I'm not comfortable being solely responsible for this. And I want the student to share that legal responsibility. And so that will sometimes send people down that private path. So that's a really key hurdle. Who's going to be responsible for this debt? And then the next piece is certainly interest rate and origination fee, where are you getting the best offer? And so that's why once you get past direct, all of these things are worth considering and weighing what's most important to you.
So there's a question, and this kind of relates to what you just said. If a parent who gets a Parent Plus loan, is the student responsible for paying it off at all?
No.
So,
And we do hear, not legally. So we
Right.
hear people sort of making side agreements, but from a legal perspective and what is on your credit bureau, what is on their credit bureau, they are not responsible for the debt.
And honestly, I've seen these situations. I've had people reach out to us that they said they made an agreement, and I understand that with their student, that when they graduate, the agreement was the parent was going to take the Parent Plus loan, but the student was going to help pay it off. And then something happened, the student couldn't help pay it off when they graduated. And it doesn't matter whatever, family agreement you had, the parent is the one who ends up being responsible for it, even if you thought your student was going to pay towards it. There's no legal ramifications that you have to get your student to pay it off.
That's right.
Okay, so maybe you can talk about your credit score, what happens when you apply for a student loan, how it gets impacted or
Yes.
doesn't, and soft credit pulls.
That's right. So some lenders, and College Ave is in this category, we offer a pre-qualification tool. So if you pre-qualify, that does not affect your credit score. It is what is considered a soft hit. It's going to give you a more concise interest rate range than what you see in the full advertised range that will be a little bit more specific based on your credit profile. It's not a guarantee, but it can help you understand if you want to submit the full application. And when you do submit a full application, then your credit will have what's called a hard inquiry, and that will affect your credit score. It can be a relatively short period of time that affects it, but when you are applying for credit, hard inquiries will affect your credit score. One tip is that the bureaus do realize that when people are taking on a loan of this type, that they shop. So they want to be able to apply multiple places so that they can compare offers. So you want to do all of your shopping within a 30-day window. And that way the bureau won't count it as multiple inquiries from multiple different lenders. They will look at it and say, these are multiple inquiries. They are all for a student loan within this 30-day window. This consumer is shopping, and they will essentially only count it as one inquiry versus multiple. So that's the trick. Do your pre-qualification whenever you want to, as often as you want to. But if it is a full application where they're going to pull your full credit bureau and do a hard inquiry, you want to do all of that within a 30-day window.
So what Angela's referring to, like this rate range, you might see on any website that shows different student loans and from different lenders. It might say, there's a range from like 5% to 13%, kind of just making it up. And that's covering every possibility of different, lenders with different credit scores. But if you have, a 750 as your credit score and you do a pre-qualification, you won't get an exact interest rate, but you get a much narrower range than the 5 to 13% range that are advertised on websites.
That's exactly right.
And then the other thing to keep in mind, I'm just emphasizing, is this 30-day window. We encourage people to shop around. This is a decision like any other, decision you would make, and you want to see what interest rate you'll get from different lenders. So take that opportunity and just know that once you do that full application, you are going to get one hard credit pull, but then apply to lots of different lenders in that 30-day period, and you won't have multiple hits to your credit. It will just
right.
be
It's the way to minimize the effect. It won't completely remove it because, again, you are applying for credit, so it will have an impact, but it's the best way to minimize it. And that's not unique to student loans, by the way. That's just a generally good credit tip, is that if you're shopping for an auto loan or you're shopping for any type of category like that, you kind of want to do your shopping. You want to try to do your shopping in that tight window, because then they will only count it as one inquiry.
Okay, so now you touched on a few features, or actually an important one, the cosigner release, but there are other features that you can choose when you're considering a private loan, and all of these features impact the interest rate that you might be offered.
So yeah, so I think we've covered cosigner release in detail, so I'll skip down a bit here. Interest rate is obviously, this is the cost of borrowing. So obviously on any loan, the interest rate is going to be a key factor. Interest rate discounts are also an important one, and it is relatively common that you can get interest rate discounts if you're willing to sign up to make your payments automatically through the lender's website. So look for that, and then assuming if the lender offers that, and College Ave is one of the ones that does, make sure that you go in after the fact and sign up to make your payments that way so that you can get that interest rate discount. Pre-qualification, we talked about that. That is a great way to shop ahead of time so that you can get a better idea, maybe narrow it down on where you think you're ultimately going to want to apply. And you can also sort of set your expectations of what is going to be, you know, the interest rate range, sort of where you're falling with various lenders.
Sorry,
yes.
before you, I realized we didn't list under interest rates. This, again, you'll see this on different sites, variable versus fixed.
Yes. So variable versus fixed. So it's actually interesting right now. Most fixed rates are actually starting lower than variable. So I can't even do my usual speech. We're in a very strange rate environment right now. So variable rates are actually starting at the moment higher than the current fixed interest rates in general on student loans. But the difference between these two things is a variable interest rate is going to change over time with the market index. The fixed interest rate is going to be set, and it's not going to change for the life of the loan. So really what you have to weigh is, how long do you think you're going to take that loan out for? How long do you think you'll take to repay it? What do you think the likelihood is that rates are going to move up or down? And then make that, and how comfortable are you with some degree of change? So if you're comfortable that you believe rates are going to go down, a variable rate could be the better choice for you. But you just have to think through what your comfort level is, that there could be slight adjustments to the monthly payments as that interest rate fluctuates.
And you know what, Angela, maybe again, before we go to the next little section, you talked about how the federal interest rates are determined. Just talk a little bit for private lenders. How do you generally determine interest rates that you're going to offer?
Sure. So the best way, the way I would sort of think about it is, you know, I think everybody's looking around at the current environment we're in, and you're seeing that it is costing more money to borrow. So if you were
across the board,
so your credit card interest rates are higher, mortgage interest rates are higher, auto loans are higher. Essentially, what it costs us as lenders, it costs more now to be able to lend that money than it did a year ago, 2 years ago. And so essentially, then that's why how our interest rates get set. What is that market? How much does it cost us to be able to lend the money? So it's sort of the simplest way to think about that and understand why we have higher interest rates now than we did a year ago.
So there's basically, you know, you as a private lender have a certain cost to borrow, and then above that, you're looking at the borrower's credit worthiness to determine what the risk is to lend to that individual borrower.
Right. Yes, that's exactly right.
Okay, so, and now, I guess now talk about the different types of repayment options and how, you know, long you could make your loan.
So this portion is actually where I think you will probably find the most differentiation, maybe in addition to cosigner release, but the most differentiation in the private space, and an area where I would zero in on as you are doing your shopping. Because some lenders will offer you the option to decide whether you start making payments right away, and if so, how much, or whether you defer until the student leaves school. Some lenders may not have all of the same choices from that perspective. Some lenders will just set your loan term. So they might say your default loan term is 15 years. We're just going to spread your payments out over 15 years. Whereas other lenders like College Ave will actually let you pick how long you want to take to repay that loan. We have a variety of choices there. And what we do is we charge lower interest rates for things like if you decide to start making payments on the loan right away while the student is in school. And maybe that's full principal and interest, or maybe that's only just the interest as you go. So it doesn't necessarily have to be a full payment, but if you commit to making some payment while the student is in school, or if you commit to a shorter loan term, so we have the dollars outstanding for a shorter period of time, we can offer lower interest rates than if you decide that you want to take a deferred loan where no payments are required until the student leaves school and you want to take 15 years to repay it. That's going to have a higher interest rate. So the choices that you can make there can help you balance your monthly budget, but it can also help you save on interest. So you can sort of find that happy medium between what can I afford each month? What do I have available to pay? But then also, how do I use these options to try to minimize that interest that I'm paying overall? There's been actually a lot of questions about prepayment penalties. So I am going to go ahead and address that here too. I know people are used to that. Maybe if you've ever had a home equity loan or other loans along that type, prepayment penalties are not common in the student loan space. They don't exist on the federal side and they're not common on the private side. That's a rule that any lender could change. They could charge one. You should ask the question, but their prepayment penalties are not common. So if you take the loan and you want to pay it back early, you can.
And can you share what you have on the College Ave website to help people kind of see when you change all of these things, how it impacts your payment?
So we have a variety of calculators and tools available that I would encourage everybody to play with. Some are a little bit more generic, where you could put in maybe offers that you have from somewhere else, or a more not specific to College Ave's products and features, but a more generic student loan calculator that is there. Then we also have calculators that are specific to our individual loan products, which do incorporate our product features. So you can compare, if I had a College Ave loan with a 5-year term and I was paying interest only while the student was in school, how does that compare to a deferred loan for 15 years? But you're really looking specifically at how do College Ave's products work. So whether you're looking for a more general calculator to understand how interest works or compare offers, that's there. And then also those very product specific shopping tools. And then once you get through our application and you're approved, we actually offer you a very similar tool right within the application. So then you have your exact interest rate and you can see how all of these choices will impact your monthly payments and your total cost. And then you would make your final decision after you're approved for the loan. So the tools are available on the front end before you ever apply, and then you'd have a similar experience once you were approved to make the best choices for you.
And maybe you can explain why it's important to fool around with these choices, because once the choices are made, can you change any of them?
Yeah, so if students get out of school and people are having trouble repaying their loans, we always want them to contact us. We do have a variety of options that are available to try to help people through short-term hardships. We absolutely want people to be successful. It's not good for us or for them if they're stuck in a bad situation. But that said, we don't just allow people to just change the repayment options whenever they want. And part of that is because we do offer those interest rate discounts if you commit to those in-school payments or you commit to those shorter loan terms. So you really do want to, when you get that offer and you can see exactly what those monthly payments during school and out of school would be, and you can see what that interest would be, with the various lengths that you take to repay it, you do really want to take the time to sort of make the best choice that you can for you there, because it's not necessarily something that you can constantly just change.
So actually, there's a good question, which I've never seen this question. And somebody's saying, can they use 3 loans within the same year? So can they do like a student loan, federal loan, and a loan with one parent and a loan with a second parent?
So theoretically, yes. The question is going to be, do you still have a need from the school's perspective based on the calculated cost of attendance? That's really what it's going to come down to. But theoretically, yes, you could do that.
Well, I guess if they want to spread it out between 2 parents, like whatever money needs to be borrowed above the federal loan.
The only answer I don't know, Debbie, I do know that either parent can take the PLUS loan. It doesn't have to be the one that filled out the FAFSA. So I know if you're a parent, either one can qualify for the PLUS loan. I don't know in a single year if 2 different parents could take a PLUS loan for the same child, but
That
you
I
could
agree
take
with,
2
yeah.
separate private parent loans, certainly, or you could take a PLUS loan and a private parent loan. So there are certain combinations there that would work. I don't think that each parent could take a plus loan in the same.
I agree with that. I don't think you can take two parent plus loans within the same year, but I think that there's this combination. One parent could take a plus loan and another
Yes.
parent could take a private, or
Yes.
both parents could end up taking two different private loans.
Yes, they could absolutely do that.
Okay. Oh, I think maybe the only other thing you want to talk about is hardships.
I think I touched on this one when we were talking about those repayment options, but honestly, the very best thing and what we always tell people is don't ignore it. If you're having trouble paying your loan, call your servicer, call your student lender, and talk about what your options are, because every lender, federal has certain options which are unique to them with income-based repayment and a few other things along that line. But that does not mean that private lenders don't have anything to offer when somebody is struggling, even if they don't have all of the same options as federal loans. So the moral of that story is, regardless of whether it is a federal loan or a private loan, as soon as you realize that you're having trouble making payments on that loan, call your servicer, because they will very likely have options to help you get through that period and stay on your feet.
Okay, this is a really important topic about what's the timing of when you should start looking at loans, and how does the money get sent?
Yes. So we are approaching the end, I guess I'll say, of that 60 to 90 day shopping window, or maybe you're right in the core of it right now. So you definitely want to be doing all of your shopping at the moment. Because really what I would recommend is, as soon as you get to the point where you know what you need to borrow, and really what I'm doing I'm speaking now to the people who have kids that are going in the fall. So people that are, really imminently facing a tuition bill. You're really in the window where, as soon as you know what you need, it's the right time to go ahead and apply for your loans. Because there are a few things that have to happen once you apply for your loan. And this actually does apply on both the federal and the private side. You just don't really probably feel it as much on the private side. But the school actually has to receive your loan request. They have to compare the loan to that cost of attendance and whether or not you actually need to borrow more to cover your cost of attendance. And they need to echo that back to us. So the school has a very important role to play in any student loan, where they certify, yes, this student is going here. Yes, they have a financial need. Yes, they can borrow for this amount. And then they also tell us when to send the money and where to send the money, because the money for student loans does not go directly to you or to the student. The money goes to the school. And then if there is any overage that you've taken for things that are not billed directly by the school, like books or off-campus housing, the school is going to refund that money to you. But everything, all of the money actually travels through the school. So it's important to not leave things, as much as you can, to not leave things to the last minute, because we need to go through that process with the school to certify the loan and then actually send the money to the school. So, do your shopping, be ready to apply. Certainly by the time you receive that tuition bill, if you know what you need before that, you can apply before that, but certainly once you get that tuition bill, and then understand the school's role in that process.
And why do you think, do you actually truly have to wait until you get the tuition bill? If I have a general idea, making it up, that I might need 30,000, do I have to wait till the tuition?
You do not. So if you know what you need, some people just don't feel comfortable knowing what they need until they've actually seen the tuition bill, because that can be the biggest piece they're borrowing for. So some people just don't feel comfortable until they actually see that tuition bill. But if you have a pretty good sense of what you need, you absolutely don't need to wait for that tuition bill. What I would probably recommend is make sure that you apply for enough to cover it. You'd be better off to get that little bit extra and then again just send it back in, versus being a little bit short, because most student loans do have a minimum, and College Ave is in this camp. We have a minimum of at least $1,000. And again, you don't want to go back for the extra credit inquiry. You don't want to go through that process again. So you don't want to find yourself just a little bit short. You want to make sure that you borrow enough to cover that bill.
And what if I start my application, with a private lender and say, I need 30,000, but then my tuition bill comes in and I actually need 25,000. can I, before I actually finalize the loan, can I reduce the amount?
It all depends where it is in the process. So yes, up to a certain point before the money is in that pipeline to be sent to the school.
Right, right.
Yes, it could be adjusted down. Or again, worst case, if the money is just already on the conveyor belt, so to speak, and we can't lower it, then you could just send it back in a payment. But yes, up to a point, essentially until the money goes to the school, there's some windows for processing. But yes, absolutely, you could call and it could be adjusted.
So somebody's asking, if you don't need the funds until the spring semester, when should they apply?
That's a great question. So when you apply, you can apply a semester at a time, or you can apply for a whole academic year. And if you apply for a whole academic year, which is pretty common, by the way, if you apply for the whole academic year, we don't send all the money at once. So when we go through that communication process with the school where they certify the loan and they tell us how much they want and when, if they know you're applying, and this is part of the application process where you identify, are you applying for a semester or for the whole year? When they see that you're applying for the whole year, what they'll typically do is basically split the loan amount you asked for in half. And we'll send the first half, say in beginning of September. That's usually when they will ask for the first half. And then they'll tell us not to send the second half until January is usually the most common time. And the great part about that is that then you know you're covered, you have the loan, but the interest, you're not paying interest on money that you haven't used yet. So you're, for that initial semester, for that fall semester where only the fall money has gone to the school, you're only paying interest on that portion of the loan. You don't start getting charged interest on the spring portion of the loan until we send that second disbursement. And you're actually using the money at that point. So you're not overpaying by applying for the whole academic year at a time.
And the other situation, right, could come into play. So if I applied for the full amount and something happens in a good way, and maybe I don't need to borrow the second half, you can go back and basically say to the lender, I don't need that additional money.
You can.
Okay. Let's see, lots of questions coming up. Oh, good question. Is it difficult to get private student loans if you've got multiple kids in college at the same time?
I don't know that I would say difficult. So I would say I would certainly use the pre-qualification tools, but there's a few factors that are going to come into play. It is going to depend on, what your credit looks like and what your income looks like. So do you have the income to cover that debt? So I would not say that it's difficult. I would not say it's uncommon, but it is going to be unique to the individual and their particular income and credit profile.
And this is where you might want to split or alternate between parents.
You do see that sometimes where parents will either trade off on kids or parents will trade off on I'm this year, you're next year, or things along that line.
And I mean, in theory, if a husband or father applies for a private loan versus, the mother, could they end up with two different interest rates?
Absolutely, because the interest rate is going to be based on that individual who applies.
Another good question. Do you have to reapply every year for a private loan? And is there a new credit check that's going to be done?
So you do have to apply every year for a private loan. In terms of whether or not a new credit check will be done, it varies by lender. So you would want to ask that question. In some instances, they can do it without pulling a new bureau. In some cases, they're going to want to pull a new bureau. I will also tell you that inquiries they impact your score, but they impact your score for a relatively small amount of time. And then assuming you don't have anything else going on, your score sort of recovers. If that helps people it's worth looking a little further into credit, what really affects your credit and how long things affect your credit. But it can vary by lender. And I would ask that question of the lender.
And what about your student? Are they going to be able to build up their credit by being on the private loan? Does that improve or, build their credit history?
It will. What I do caution people with is if let's just say you have an 18-year-old freshman and the only thing on their bureau is a student loan, by sophomore year or junior year, it doesn't mean that they're suddenly going to qualify for that year's loan by themselves, because they just probably still don't have sufficient history in terms of depth and breadth of history and that type of thing to qualify on their own. So it's a great start and it can help them build credit. You do need positive history though. So once that loan has payments due, it's going to benefit them from a credit perspective if payments are getting made on that loan. If payments begin on the loan and they're not making payments, then obviously that's going to have a negative impact on their credit bureau. But it is absolutely a way that they are establishing a credit history and can be a positive builder.
There's a good question here about if a student takes out subsidized and unsubsidized loan, and the family takes out a private student loan, do they all have to be paid back at the same time?
Generally, yes, they would probably be on a similar repayment schedule, but each loan is going to have its own terms. So for example, with a college ave loan, you could decide you're going to start making payments on it right away. And maybe you pick a 5-year term and you go very aggressive to just get that loan paid off. Versus on the federal loans, you just decide to stick with the standard 10-year repayment plan. You'd have to look at each loan's repayment options to see if there are ways that you could manage that. But in general, yes, the payments are going to be due at the same time.
And actually, that's another question that somebody asked, which maybe we didn't really clarify enough. How long are the federal loans, and do you get the chance to change, how long you get to pay them back?
The standard repayment term is 10 years. And the standard is that for the direct loans that are in the student's name, payments are not required to begin until they drop below half-time enrollment. And then they also do have a grace period of 6 months, essentially, after they drop below half-time before those payments become due. That's the standard. You can make payments ahead of time. There is no penalty for that. You might have to do a little bit of work to figure out who your servicer is and where to send them, but there's no reason that you can't start making payments if you want to. If you want to extend that term, there are options on the federal loan. You would want to call that servicer and discuss what your choices are. But there are a variety of ways that it may not be as simple as just saying, I want to extend the term 15 years, but through some of the income-based repayment plans or some of the consolidation plans, there's ways that you can modify those sort of default terms, so to speak.
So somebody's asking, this is interesting, if they pre-qualify for a private loan, does that have any impact on a Parent Plus loan?
No.
Right. So the two things are separate.
They're totally separate. The only impact would be if you ask for both to go to the school to certify and you don't have a high enough cost of attendance to warrant both of those. What you would probably get is a call from the school saying, you just don't have a high enough cost of attendance to get both of these things. Which one do you want? That's the only effect you could have if you applied for both of them and you let both of them go all the way down the track to the school.
So somebody's asking, do private loans have deferment until after graduation?
So each individual lender can set their terms, but it is common for them to offer a deferred option so that students can wait until after graduation to have any payments that are required. College F does have that, yes.
Somebody asked, there's a few people have asked this question about how to use their savings, meaning, if they don't have enough to pay for all 4 years, should they use all of their savings, in the first year and then borrow later? Do you have any advice about how to go about figuring that out?
So my main caution there would be that there is probably not a universal rule for that. And I would highly recommend that you sit down with a financial advisor to go through your specific situation and figure out what would be best for you. The factors that I think you're going to want to consider are those direct loan limits, those annual direct loan limits. So you will want to factor that in, because if you want to max those out, you may be better to take that $5,500, even if you technically could cover it. So that's a factor that you want to put in. It is not a hard and fast rule that you should. It is a factor. I would also consider personally, where are interest rates currently? And where do I think interest rates are going? And what's going to be the cost of borrowing? And again, you're making some guesses there. But that's also why I would want to sit down with a financial advisor and sort of map the whole thing out. There's just not one clear-cut rule of thumb from that perspective. What I will tell you is a useful rule of thumb. If you're thinking about like, how much should I be borrowing? How do I think about what the right limits are? Or how do I think about what the right amounts are to borrow? The rule of thumb that we use is generally, if the student doesn't borrow, or if you and the student don't borrow more than that student is expected to make their first year out of college, then they will probably be able to pay all those loans off within 10 years. So if when the student graduates, they think they're going to be making $50,000, if they don't borrow in total from private or federal more than $50,000, then they're probably going to be in good shape to repay those loans over the course of 10 years. So it's a good sort of test, and it is really helpful where you should be thinking about, what are they majoring in? What is their income going to be? How do I borrow, but make sure that I'm borrowing for the right return, so to speak, from a salary perspective. So that's a good rule of thumb to use. But in terms of a rule of thumb for when to use your savings and when to borrow, it really is very much an individual financial decision.
But that's why it's so important to look at the 4 years, look at, what money you have and how are you going to use it over 4 years. And as Angela said, there's not a black and white, answer to that. Because some people, it also might relate to credits that you can get, educational credits. And so you want to kind of plan it out. Maybe you could do it yourself, or maybe you want to ask, a financial advisor to help you plan it out. There's a question, a few different versions that have come up. Maybe you could explain, is College Ave a bank? And are there, do banks offer student loans? Are there state agencies that seem to offer student loans? Are those private loans? Are those federal loans?
Yes. So if it is not coming, if it's not a direct loan, and if it's not a plus loan, it's not a federal loan. So all federal loans at this point go directly from the government. They are those direct loans in the student name, or they are Parent Plus or Grad Plus. If it's not them, it's not federal. There are state agencies that offer loans. Those would be considered private loans that the state agencies offer. College Ave is not technically a bank. We do work with banks to be able to lend. And in terms of, do most banks offer private student loans? Actually, no. So what we often hear from people is they assume that they're going to go to just wherever their checking account is, or they're going to go to what they consider sort of their bank, so to speak. And the reality is that most banks actually don't play in this space. They actually don't offer private student loans. And part of the reason is everything we just went through with all of the mechanics with the schools. It is a very unique loan to produce, because nothing else works that way. So a lot of banks just don't offer them. So Chase doesn't offer student loans. Bank of America doesn't offer private student loans. So I also definitely don't want people to assume that you're just going to go to somewhere that you already bank and they will have it. What you may find, we actually do work with some banks where they will refer customers to us. But you will find that many of the biggest players in the space, again, the Chases, the Bank of Americas, the Citibanks, they actually don't have private student loan programs.
And maybe you could just talk a little bit more about those state agencies, because I think that's a really good distinction, that if it's not a direct loan, if it's not a parent loan, those are the only federal loans. Everything else is a private loan. So I think it's a little confusing. I mean, I'm in Pennsylvania, the Pennsylvania FIA, promotes their loans, but it really, even though it has the state of Pennsylvania kind of name on it, it is still a private loan.
It is still a private loan.
You shouldn't be confused and think I'm going to get these federal protections.
That's exactly right, Debbie. It is if it's not the direct loan, if it's not the plus loan, it's not a federal loan. So do not assume it has those protections. Everything else, state agency, anything else you might see, Sally Mae, anything else you might see, those are private student loans. And so the reason that distinction is important, to your point, is that each of those individual lenders sets the rules for their products. So you can't assume that any of those aspects that are on the federal side apply to any of those other lenders.
So they're kind of like state agencies playing in the private market.
They are, they're the ones making the loan, but they're private loans. That's exactly
Right.
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 That's exactly right.
Okay. Somebody mentioned that they like my hoarse voice, but
Oh.
this was great. Thank you, Angela. There's a lot of questions here, a little bit more related to divorced parents. And I think we're gonna, I think it would be better that we summarize them and send something out,
Right.
kind of answering those questions. Both because we want to make sure we're providing the best information and they're a little bit more complicated topics. But this was great information. Hopefully the families with seniors that are becoming freshmen, I mean, they're in the midst of dealing with this. The existing college students, maybe they've gone through this once, but they got to go through this again and again this year. And I think it's great if you were a family here with a junior, that you got a taste of what you're going to have to deal with, but also you factor that in to the admissions process that you're about to go through.
Yes.
So I'll record an email with a recording. A link to this recording will be sent out so you can watch this over again. And we also send out what we call a tip sheet, which is a summary of some of the most important things that we talked about today. So you'll be able to have that too, it's just as a reference. And feel free to reach out to me with questions, and I will usually reach out to people at College Ave to also answer these questions. But just know that you can, this isn't a one and done. I mean, we spent a lot of time discussing stuff tonight, but as you come across questions, feel free to reach out and ask them. Great. Well, thank you, Angela.
Thank you, Debbie. Thank you, everyone, for your questions.
And we will see you again soon.
Good night.
Okay. Bye. Good night.